We've talked about estate tax issues that relate to IRAs and other similar retirement accounts, but you should also know that there are income tax rules that are important. Keep in mind that when the participant or owner of a retirement plan account dies, the general rule for how quickly the balance in the account, that IRA account, must be withdrawn is 5 years. That's the general rule, but there's exceptions to the rule, and the exceptions are the ones that you want to try to use. One important exception is that if you name an individual as the beneficiary of the IRA, then at your death, the death benefit can be paid out in dribs and drabs, they're called required minimum distributions, over the life expectancy of the individual beneficiary. A surviving spouse is a special type of individual beneficiary, however. In the case of a surviving spouse, who is the beneficiary of her deceased husband's IRA, the surviving spouse can take the IRA, roll the whole balance over into her own IRA, and treat it as her own. As a result, she'd have no required minimum distributions until age 70 and a half, at which time she'd have to start taking required minimum distributions. And like I said before, this kind of in dribs and drabs over her life expectancy, actually a little bit longer than her life expectancy, according to the tables issued by the Internal Revenue Service. Since IRAs and other similar retirement accounts earn income and grow on a tax-deferred basis, they have a favored tax environment. And the idea is to try to keep the funds in the favored tax environment as long as possible. So the strategy typically used is to stretch those payments out for the longest possible time. As a result, if the spouse is the beneficiary of your IRA, you want to make sure that the spouse, or it's very common to make sure that the spouse can receive the IRA account balance and roll it over into her own, and then take required minimum distributions in the minimum amount. And then at her death, the balance in the account goes to beneficiaries, and the beneficiaries' life expectancies can be used for taking those required minimum distributions. So you've got deferral in a number of different places. One, when the IRA is paid to the surviving spouse and rolled over, you've got deferral there because you don't have to take any required minimum distributions until age 70 and a half. And then you've got deferral over the life expectancy of the spouse. And then when the spouse dies, you've got deferral over the life expectancy of the beneficiaries. If a non-spouse is the beneficiary of the IRA, then there's only deferral for a period of time equal to the life expectancy of the beneficiary. And of course, if an individual is not the beneficiary of the IRA, if any of the IRA balance could go to a non-individual like an estate or a charity or a non-qualifying trust, then the benefit must be paid out over 5 years and no longer. That's the case if the IRA owner participant has not reached the required beginning date, that's 70 and a half, before he or she passes away. If the IRA owner participant reaches the required beginning date and then dies, the beneficiary may take the death benefit over the remaining life expectancy of the owner participant, determined as of the date of the owner participant's death. And that's true even if the beneficiary is not an individual. In our next segment, we'll be talking about revocable living trusts, will substitutes, and probate avoidance.